This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. A negative lead-in for Asian stocks, with Wall Street giving up gains as a Fed chair stresses that today's half-point rate cut is not the new normal.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen.
Also ahead, Israel signals a new phase in the Middle East conflict after a second wave of device explosions in Lebanon. And US officials in Beijing for fresh talks on economic tensions, while China's trade minister tackles EV tariffs in Europe. And of course, as is typical, following on the heels of any move from the Fed, we do have the Hong Kong Monetary Authority cutting its base rate to 5.25%. Now, this is also quite interesting in the sense of what the implications are going into the next few months for the Hong Kong dollar. Bloomberg Economics expecting that the prime rate could still hold until 2025, the Hong Kong prime rate, that is despite Fed rate cuts, but certainly some of that pressure could be alleviated when it comes to rate differentials. There's some concern that the dollar peg for Hong Kong, which is of course why we see that sort of following of the Fed, could be targeted if former President Donald Trump wins the re-election, implements that old proposal to limit Hong Kong's access to the greenback. But economists do expect that the key driver will be rate differentials for that Hong Kong dollar spot rate. So watching to see for a drop given the move from the Fed, Shery.
Yeah, when we saw the greenback really paring back some of those earlier declines, really the question about the Fed with this outsized 50 basis point move, was this a really reactive sort of action given that the economy is already slowing at a faster pace than the policymakers want to see? Or is it a proactive move in order to really avoid that sharp slowdown, right? I mean, the Fed is trying to portray it as a very proactive move. They want to get ahead of the curve, but at the same time, of course, those doubts remain. Take a listen to exactly what Chair Powell had to say.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
What is really interesting, of course, is looking at the dissenting vote on this decision, right? Michele Bowman putting through that dissent. This is relatively rare when it comes to Fed decisions, casting the first dissenting vote by a Federal Reserve governor since 2005 here. She preferred to cut rates by a smaller amount during the policy meeting on Wednesday. Of course, they cut by half a percentage point. She was in favour of 25 basis points, according to a statement by the Fed. She has really been on the cautious side when it comes to disinflation. In August, she said that price growth remained uncomfortably above the Fed's 2% goal. She's been arguing for the gradual lowering of the Fed's fund rate. So this is quite interesting, saying that, given the backdrop of just how unusual it is to have a dissent, particularly during Chair Powell's tenure. The last one was in June 2022 from Esther George, who dissented in favour of raising rates by a smaller amount. So interesting that perhaps this is not kind of a broad consensus even within the FOMC, Shery.
Yeah, really that debate between gradual moves or really front-loading the easing cycle from the Fed, right? But take a look at how we're setting up for the Asian market opens, because, of course, Japanese equities were under pressure for the last two sessions because we had a strength in the Japanese yen. We continue to see a little bit of that strength, but still hovering at around that 142 level. So after two sessions of losses, we are seeing Nikkei futures pointing to a little bit of upside. Sydney futures, though, slightly down. We did get New Zealand second quarter GDP numbers. Yes, again, contraction, but contracting by a lesser amount than economists had expected. Really, offshore yuan not doing much. We'll be watching those moves by the greenback. Take a look at how U.S. futures are coming online in the Asian session, because the U.S. dollar pared back some of those earlier declines. A lot to do with the function of what treasuries were doing, because that rally that we've seen in the past couple of weeks really took a breather today again, and we had the 10-year yield sitting at around that 270 370 level. But take a look at U.S. futures right now. We had seen it really rally about 1% for the S&P 500 when the decision for that outsized rate cut came out. But as we heard Chair Powell speak, and we got the sense that really he was in no rush to continue easing at this pace, we actually had U.S. stocks falling, treasuries falling, also treasuries rising as well, and then we have the dollar falling. Haidi.
Yeah, Shery, let's get some more perspectives from our next guest. Dana Peterson is the chief economist at the Conference Board. Dana, great to have you with us. And, you know, clearly when you talk about this first dissent from a Federal Reserve governor in almost 20 years from Michele Bowman, there was clearly a lot of discussion as to the right path forward, right? Do you think the Fed got it right? I know you were in the 25 basis point camp as well.
Yes, we were in the 25 basis point camp because we felt anything greater than 25 basis points would signal if there's something wrong with the U.S. economy. However, I think the Fed really tried to thread the needle today or on Wednesday and basically provide something for everyone. Yes, they cut interest rates by 50 basis points to address the naysayers who are the doomsday sayers who say that the U.S. is on the cusp of recession. But then the Fed spent a lot of time talking about how strong the U.S. economy really is. Growth is solid, the labor market is okay, and also inflation is cooling in line with their expectations back to 2%. So with all of that, I think the Fed definitely did compromise here, but I don't see there's any big concern from the Fed that they need to continue to cut interest rates by 50 basis points meeting after meeting. They're going to be moving slowly and gradually.
The dot plot really suggests that this is, proactive but gradual, a start rather than a trend, right, in terms of what to expect. If you take a look at markets, so traders are pricing in a lot more aggressiveness from the Fed. So do we expect to kind of continue to see this dislocation? And to what extent was this kind of Fed Chair Powell and the FOMC wanting to, put something out there that made everyone happy?
Well, I think the key thing is that the Fed is continuing to say that it is data dependent. So incoming data are going to help them to determine how quickly they're going to cut interest rates and by how much per meeting. Indeed, Chair Powell and even the policy statement indicated that the Fed may wait a meeting, they may skip meetings, they may pause, they may do a lot one meeting or a little another meeting. They're just really leaving it up to the data. So if we continue to see that consumer spending and consequently GDP growth in the third quarter was healthy and strong, and also we don't see any further material weakening or slowing in the labor market, and inflation continues to trend back to 2%, probably getting there sometime next year, I think the Fed can feel comfortable cutting gradually, another 50 basis points this year, according to the SEP, and then another 100 to 125 basis points next year.
How big of a story was the dot plot, given that really traders still expect more easing than FOMC officials at this point?
Well, I think traders are, pricing in. They like to price in everything and expect everything to happen right away. But that's not how the real economy works. In the real economy, inflation is still above the 2% target. Prices are still quite high. And interest rates need to remain at at least have a degree of restrictiveness to continue to push inflation downward. There are a lot of upside inflation pressures, including higher costs for labor that companies are passing on as baby boomers retire, and they have to raise wages to attract and keep talent. Also, we have a number of issues with housing. We don't have enough housing supply in the U.S., and so home prices are elevated, and that's putting upward pressure on consumer inflation gauges. You also have deglobalization, where companies are bringing back their supply chains from abroad to the U.S. All those things cost money, and those cost increases are going to be passed down to the consumer. So the Fed needs to make sure that it carefully calibrates the deceleration of interest rates, so the cutting of interest rates, to make sure that inflation does not rear back up and resist all the work that it's been doing.
Yeah, I was going to say, is inflation in the back burner right now, and how big of a risk is that?
Well, I think the key things is that most of the inflation we're seeing, or nearly all of it, is in services. And a big chunk of it is housing and shelter costs. Now, we know that home prices and also rents have decelerated in the U.S. in the past, but it takes about a year and a half for it to show up in inflation gauges. So little by little, we are seeing shelter costs slow. But even Fed Chair Powell said that shelter costs are slowing not as quickly as anticipated. Then you have other services costs that are rising. Indeed, insurance costs are very elevated for healthcare, autos, and also for homes in the U.S., and that's putting upward pressure. And then finally, again, back to labor shortages, many companies are having to keep wage increases elevated and also offer bigger bonuses and benefits. And all those things, again, are going to be passed down to the consumer. So that's why we haven't seen inflation drop back to 2 overnight, and it's going to take some more time to get there.
There's been a lot of discussion about the FOMC's reaction function and whether we're seeing more of an emphasis on unemployment. Did we see that in the narrative at all in this decision?
Well, they gave mixed news on the labor market. On the one hand, they said that they are concerned about the downside risks to the labor market. Indeed, in the Beige Book, a number of regions in the U.S. said that they're seeing cuts in hours. Also, when you look at payrolls, we had data from the QCW database that suggested that non-farm payrolls over the last year or two have been stronger and need to than expected, and indeed will be downwardly revised. So that's the negative news. But then the Fed said, hey, look, the unemployment rate is still very low at 4.2%. And indeed, their outlook for unemployment only edges up a few more tenths of a percentage point to 4.4%. And 4.4% is really, that's the natural rate of unemployment. That's the point where the labor market is not either generating inflation or generating disinflation or deflation. It's kind of the Goldilocks spot. So the Fed is saying, on the one hand, we are concerned that the labor market could weaken further, but right now we don't really see anything that's really disconcerting about the labor market.
Dana Peterson, chief economist at the Conference Board. We do have more reactions to the Fed's jumbo rate cut coming up on the Asia trade from across asset classes. Circle's CEO joins us to explain the impact on crypto and stablecoins. Plus, Nikko Asset Management gives us their economic overview, and we check the fallout for FX markets with RBC.
And coming up tomorrow, Shery will be speaking exclusively with the New Zealand Prime Minister, Christopher Luxon, as the country's economy teeters on the edge of its third recession in 2 years. Do join us for that conversation at those times on your screen. Plenty more ahead. This is Bloomberg.
Here's the headline. Fed cuts interest rates by 50 basis points and the bond market returns are going to be negative today.
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about.
The market's going to look at the median dot and will interpret this as a dovish 50 basis points cut. And the first reaction was actually a steepening of both 2s10s and 2s30s, which tells you something about what people are worried about.
We would have liked to have seen the median dot for the end of next year somewhere around 2.75% to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you 250 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good.
Some of our guests are reacting to the Fed's 50 basis point rate cut. Let's bring Garfield Reynolds, who leads our markets live coverage in Asia. And I don't know if we talked about whether you were in, camp 50 or camp 25 going into this decision, but it feels like the Fed has tried so hard to thread the needle, if you will.
Yeah, very much so. And I think ultimately this came down to the growing concern that if they're going to act, They need to act decisively. You know, it was notable, Powell saying if they had known what the jobs report ultimately delivered for July, when they met in July, then they would have cut then. So in some ways, this is sort of them going, oh, okay, we should have cut in July and then cut in September. We didn't cut in July, so we've got to do 2 in September. And I think that's the way to comprehend what Powell meant when he said, just because we've gone 50 this time, don't expect us to go 25 each time. He's sort of stealthily admitting that they got a little bit behind the curve, but he doesn't think they got far enough behind the curve that they can't fix that by doing 50. Now it's back to 25 basis points for the next 2 meetings, provided the data continues to stay where it is. They're very much in data-dependent mode. So if we get significantly weaker employment reports, or if we get significantly stronger employment reports or a significant tick up in inflation or inflation pressures, that will change things going forward. The weaker jobs market, that would put 50 back on the table for either November or December. A stronger jobs market and or some inflationary pressures coming through, that would have the Fed thinking, well, maybe we don't need to go at both of the remaining meetings this year.
There's a big gap to be closed then between what Chair Powell is saying, what the dot plot is showing, and what the market is thinking. Yeah,
very, very much so. And the summary of economic projections showed some level of concern about the economy, a sufficient level to potentially justify more rate cuts than ended up being there in the dots, and it certainly didn't necessarily justify the reluctance with which it seems that they faced in going 50. But even so, what the Fed is seeing does not match with what the bond market is seeing. And that's why, bonds, equities fluctuated yesterday. Bonds pretty clearly moved lower. Yields went higher. So that tells you that the Fed is out of sync with where the bond market thinks rates should be going.
A lot of profit taking as well, right? Given that we saw the 5-month rally in the Treasury space. But I wonder, given that Chair Powell continued to say that the economy is, quote, basically fine, what does that necessarily mean for the fact that they still went ahead and did this historic 50 basis points cut, which is usually linked to economic crises? What does that mean for the markets, I guess?
Well, it means for the markets that the path is actually very uncertain, especially, if they'd cut 50 and signaled, and sort of accepted that they were going to be cutting at that sort of pace fairly often, then yes, that would be them saying, oh dear, we're heading for a recession, or, well, we're in danger of entering a recession, and so we are willing to do whatever it takes. Channel the old Mario Draghi stance a bit. On the other hand, if they had gone 25, then they would be, just clearly saying, hey, that would be a full endorsement of the idea the economy is doing just fine and that the soft landing is clearly in front of them. So I think that helps to explain the way equities, fluctuated. They rose as much as 1%. They closed down 0.3%. Futures today are up about 0.3%. So they're kind of back to flat, back to where we were before the Fed cut. So equities are facing a bit of an uncertain outlook, because that question, soft landing or no, is still a very difficult one to decide. I think the one caution too going forward is that the Fed has a history of, however strongly or otherwise it starts off its rate cutting cycle, it starts its rate cutting cycle thinking that it is in the process of engineering a soft landing, and and then it runs into something like Lehman Brothers, like the ultimate meltdown that came in the wake of the dot-com bust. That means it has to cut far further and faster than it had anticipated.
Garfield Reynolds, who leads our Markets Live coverage here in Asia as we react to the jumbo-sized Fed rate cut there. You can get, of course, much more when it comes to looking ahead to the BOJ decision on Friday. TLIV Go with that commentary and analysis from Bloomberg's expert editors. More ahead on the Asia trade. This is Bloomberg.
Obviously, the logic of making all these devices explode, indication that this event confirms that there is a serious risk of a dramatic escalation in Lebanon, and everything must be done to avoid that escalation.
UN Secretary General Antonio Guterres is speaking ahead of a high-level session of the General Assembly. Well, Iran is threatening to retaliate after its ambassador was wounded in a wave of explosions that targeted pages and other wireless devices in Lebanon. Hezbollah, the Lebanese government, and Iran all blaming Israel for the near-simultaneous blasts. Meanwhile, Israeli Defense Minister Yoav Gallant ushered in what he calls a new phase in the war in the Middle East. Bloomberg's Michael Heath joins us now for more. And certainly, you know, if it is Israel, this is just so audacious, this series of attacks.
Audacious is the word, Heidi. Yeah, I mean, it's just extraordinary. And these low-tech devices, whether it be walkie-talkies or pages, you know, it's just so unexpected. But it does feel like we have entered a new phase. And the question sort of seems to be, is Israel sort of testing the resolve of Hezbollah? I mean, Hezbollah is a serious organisation. It's dangerous. It's the most dangerous of the sort of axis of resistance, excuse me, that surrounds Israel and is sponsored by Iran. But both Iran and Hezbollah are already due to retaliate to Israel and haven't really done so far. So it's a real question then how they respond to this, you know, what they do or whether they hold their fire for now again.
You rightly talk about, you know, we were trying to work out, you know, whose turn is it to retaliate, right? And there has been a sense of restraint or, you know, really strategic ways of retaliating without threatening a region-wide conflict, right? What is Israel trying to achieve potentially by, you know, doing this in such a brazen way?
Well, it almost seems like Israel's trying to see, do they just talk but not walk the walk, Iran and Hezbollah? Because, as you say, I mean, they're sort of due to retaliate for the assassinations that occurred. Obviously, the head of Hamas in Tehran and a senior Hezbollah official in Beirut. And so, if nothing happens after this, then the question is, you know, are they afraid of Israel, or are they just determined to wait until the timing is right for them? The question, though, becomes that if they retaliate, then how serious does it become? Because if Hezbollah fires missiles, say, into central Israel, that's almost certainly a case for Israel to more seriously respond, and then we deteriorate probably into war, and we've got that wider conflict we're talking about. Israel and Hezbollah have been waging a sort of proxy fight where they're firing missiles at each other, but near the border regions, which has required the evacuation of people on both sides. And one of Israel's points is it wants to get its people back into those border communities, and so it wants Hezbollah to pull back. So again, it almost feels like Israel's, number one, it's showing that it's vulnerable to Hezbollah, but that it's testing its resolve.
Bloomberg's Michael Heath there with the latest as we continue to watch developments in the Middle East. More ahead on the Asia trade. This is Bloomberg.
Emerging market currencies trading still at around record highs. We had 6 sessions of gains, but they did trim some of those gains after briefly soaring on that Fed rate cut, which was, of course, outsized in 50 basis points. But at the same time, they just sort of came down from session highs when Chair Powell signaled that they're not necessarily in a rush to keep cutting at this pace. So we had the Mexican peso also falling to that 19 level, a little bit sensitive to U.S. economic risks as well when it comes to the Mexican peso. And that could be at a disadvantage if the U.S. economy slows down. Now, one outperformer, as you can see there, was the Brazilian real. We're talking about being one of the biggest winners in today's session and trading at at a one-month high. Brazil's central bank has increased its benchmark interest rate by a quarter point in the first hike since 2022. For more, let's bring in Bloomberg's Maria Luisa Capurro in Brasilia. Maria Luisa, so we know that this central bank has been really ahead of the curve and really going faster than most global central banks in hiking, in easing. But why hike again now when the Fed has just cut rates?
Yeah. That's a great question, Shery. Well, most importantly than this hike, the fact is that Brazil's central bank just announced that this is the beginning of another tightening cycle. The only thing that the bank didn't say on tonight's statement was the size of rate hikes to come. At this point, the curve is pricing in a 50 basis point hike for their next meeting in November, so faster hikes at their next meeting already. There's a few reasons through which the bank is justifying this decision. Activity is stronger than expected. We saw GDP numbers shooting past all forecasts in the second quarter of the year. Unemployment is really low, and inflation estimates are above the bank's goal. There's a few technical pieces of information in today's statements. The bank's own inflation estimates are half point above their goal. They're saying that inflation risks are tilted to the upside, and at the same time they see a positive output gap. So it all stresses that they are concerned with a heated activity that could add pressures on services costs.
There's also a power transition at the helm of the bank as well. Is that having any sort of influence?
Yes, we have Gabriel Galípolo, who is waiting his Senate confirmation as governor for next month. And he came into this rate decision after several public speeches. In fact, the bank got a lot of criticism on how many public events they were participating on. And in those instances, Galípolo sounded surprisingly hawkish. This is a policymaker who has been at the bank for over a year now. He was the prior right hand to the finance minister. He's a close ally to President Lula, who we know has been demanding lower rates for a while. And Galípolo himself voted for a bigger rate cut back in May when the easing cycle was still ongoing. So all of that made analysts label him as a dog. But recently, he has been saying he's willing to do whatever it takes to tame inflation, including raising rates. He even said that being a central banker who fears rate hikes is almost as a medicine student who is afraid of blood. So his speeches really set the tone to today's hike. And the fact that this decision was unanimous also helps the bank credibility going forward.
Maria Luisa, so we know that the central bank has been really out of step with other major central banks. What can we gauge about some of the risks of being an outlier when they're hiking rates and the Fed and other central banks are easing?
Yeah, in fact, we're going against all of Latin America. Basically, most of our peers are either still cutting rates or holding. Brazil now is an outlier. Rates were already restrictive. This hike takes them all the way to 10.75%, and that many see actually the bank going further, taking rates all the way to 12% in the following months. So tomorrow, what we're expecting is a positive reaction on the real, stronger real, given rate differentials with the U.S. That's good news for the central bank, should help them with their inflation fight. But we'll have to see in the weeks and months to come what this tightening cycle means for credit flows that were bouncing back, and also for investment. And investment on top of families' consumption was also one of the main drivers for the stronger GDP prints that we've been seeing.
Bloomberg's Maria Luisa Capurro there joining us from Brasilia with that outlier central bank that's actually hiked rates at a time when the Fed and other major central banks are on an easing cycle. Take a look at how we're setting up for the market opens across Asia. We could see some gains for the Nikkei. We have seen the Japanese yen under a little bit more pressure, but still holding at around that 142 level. Also, we had Japanese stocks already losing ground for two sessions. Sydney futures to the downside of about 0.5%. of course, we continue to watch the Aussie dollar. We do have the RBA rate decision next week. We actually have we're not done when it comes to central banks, right? I mean, we do have the BOE. We have also the Bank of Japan, of course, on Friday. U.S. futures pointing to the upside of 0.3% after we saw a session of losses. There was a lot of volatility up and down as investors were trying to gauge where the Fed goes from here. Bloomberg opinion columnist William Dudley says he expects another rate cut in November. The former New York Fed president also told us the central bank has successfully delivered a message that today's 50 basis point move was based on good news, not bad.
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you do 50 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good. We've made progress on inflation, as opposed to we're doing this because the news is bad. So I thought it was a very, he's providing reassurance to people that the Fed thinks that they've got it. Also, when he's asked about, the SOM rule and the risk that the unemployment rate could go up by quite a bit more, pretty reassuring on that. Thinks that the labor market can stabilize close to where we are today, and that's really hugely important because, if the labor market doesn't stabilize, then we will have a mild recession, and then the Fed will have to ease a lot more. So I thought the general tone of the press conference and the statement was, we've got that. We've got it.
Bill, congratulations. Your essay today, you think you were one of the Fed whisperers everybody's talking about out there right now. Bill Dudley, I look at where we are and where we're heading, and it simply comes down to the strength of the American economy. Forgetting about the theater of recession, where does GDP settle? Whether real GDP or nominal GDP, how do you envision that in a year or even 2 years?
I think if you look at the Fed's forecast and look at how that growth affects the unemployment rate, the Fed thinks that, growth in the medium term is going to be 2% plus at an annualized rate. So, and that's sort of what we're doing right now. So, the Fed's got a sort of soft landing in place. If the economy continues to grow at the same pace as it's doing right now, the unemployment rate will stay relatively stable. You saw in the summary of economic projections, the Fed shows a very modest further increase in the unemployment rate from 4.2 today to 4.4%, but nothing beyond that. So it's sort of a soft, if you look at their forecast, it's a soft landing kind of story, and I hope they can pull it off.
Bloomberg Opinions, Bill Dudley there speaking with our colleague Tom Keene. Take a look at the crypto side of the reaction to the jumbo-sized Fed rate cut that we had overnight. And we had a pretty favourable reaction overall, Bitcoin rising and some of the other crypto gains after the Fed cut for the first time in 4 years, of course. We are seeing a little bit more of an upside there, about 1.7% to the upside for Bitcoin. And, of course, some of these riskier assets really kind of benefiting. We saw an initial bump of about 2% for Bitcoin. It'll raise that increase. But it's still kind of sitting just over that $61,000 level. Let's get more on this from Singapore. Our tech reporter Annabelle Jewellers is there with our next guest, whose company issues the world's second largest stablecoin, Bell.
Thanks, Heidi. Yeah, joining us this morning is Jeremy Allaire, Chairman and CEO at Circle. And Jeremy, I guess that Fed rate cut really kind of is sort of a double-edged coin for you guys, because at the one hand you're of course you lose possible source of income when the Fed cuts rates, given you've got that money that can't be put in and made to work as much with a lower rate. But then at the same time, you've got that interest that can build for more speculative assets. And even though perhaps a stable coin isn't necessarily a speculative asset, it still sits within that sort of broader basket of cryptocurrencies. So what is your reaction to the Fed rate cut?
So my view is lower interest rates are critical to both the real economy, but also to the investment economy, meaning how people invest, the amount of capital that kind of comes off the sidelines and gets put to work in investing in assets, investing in growth. And the sort of ideal neutral interest rate, which apparently is around 2.9% according to the Fed dot plot, that I think would be an excellent interest rate. And what we want to see is more money velocity, more utility for money in the economy, and I think lower interest rates definitely support that. And so we think this kind of move down in rates should be a really positive catalyst for growth and adoption in stablecoins.
Growth and adoption, I think, also speaks to sort of what's been one of the major themes at Token 2049 this year, which is sort of searching for that next narrative for the industry as well, and also looking for that mainstream breakthrough. Yeah. What's the point, do you think, where stablecoins actually enter the everyday lexicon for people?
Yeah, I mean, in some parts of the world, it is very much in the everyday lexicon. If you go to Argentina, it is in the everyday lexicon. If you go to some markets in countries in Africa, the same thing. And so it's fascinating to watch how this technology gets adopted in different parts of the world. But I think, uniformly, 2024 has been the year that stablecoins kind of decoupled from the rest of the crypto market in terms of transactional growth, in terms of active users, all these things that are indicators of utility. We've seen that, and we've seen that in the numbers, and we're certainly seeing that in our business, where the demand for using stablecoins, which are essentially just digital dollars that work as efficiently as the internet, which is to a person who uses them super intuitive. That has started to really grow in international markets, in emerging and developing markets, SMEs, individuals, households, firms, adopting this as just a better way to store value and a better way to conduct transactions and international transactions. So we're seeing that happen. I think there's certainly in the mainstreaming of all this, these are kind of like what I'll call like early adopters who figured it out. The real question is what's necessary to get us to much broader scale mainstream adoption all around the world.
And I guess part of that also depends on the amount of regulatory clarity that you can gain for the industry as well. What are you seeing in the US, and how dependent do you see that as well being on the outcome of the US election? Yeah.
So legal certainty on the treatment of stablecoins as a kind of legal electronic money is really critical. The good news there is that in almost every financial market center in the world today, there is active stablecoin legislation or laws that are either going into effect or are very close to going into effect. And so that's here in Asia, Japan, Hong Kong, Singapore, UAE, the EU, which is already in effect. USDC, the digital dollar issued by Circle, is in fact now issued as legal electronic money in Europe. And so that's clarity that's really, really powerful. In the US, we have to get through this presidential election, obviously, and I think there's rhetoric about pro-crypto or being pro-business entrepreneurship innovation, which is sort of the language we're hearing from the Harris campaign. But on the ground, when you go actually look at the work that's been done, the Payment Stablecoin Act, which is the primary legislative vehicle, it's very nonpartisan. It's got strong support from Democrats, Republicans, and so I think that's going to be a piece of legislation that moves. And the rest of the world is waiting on the United States to put its rule book down and say digital dollars that are privately issued that work as money in the financial system. Here's the framework, let's go.
Do you see that solution continuing to be led by the private sector as well? Because, for instance, you've been quite public in linking the need for regulatory certainty and progressiveness on that front to ensuring the continued dominance of the US dollar. But what is the risk then that you also have more public sector solutions as well? For instance, Wyoming is one that's looking at issuing its own stablecoin now for the state.
Yeah, I mean, I think experiments are experiments, and I don't have much to say about that particular instance. But in the West, and in many other parts of the world, but certainly in the United States, free market competition, private sector technology innovation, and well-established rules and regulations are kind of how the system's been built. And whether that's in the development of the internet, the development of self-driving cars and electric vehicles, private space travel, and certainly areas like crypto and even in other parts of the payment system. Almost all the kind of payment technology, payment system innovation has been private sector led really for the last 50 years. So I think there's an inherent understanding that the private sector can move much faster, improve technology much faster, reach the ultimate end users most effectively. But what's critical is that because a stablecoin, a dollar stablecoin like USDC, is a form of money creation, in Jay Powell's words, it needs to have a Federal Reserve set of kind of standards around it, right? And that's what's going to give everyday institutions and people confidence that, there's sort of ACH bank money, there's stablecoin money, there's these different forms of electronic money, and people need that conveyance to be able to say, hey, I'm going to use this for anything in my world.
Just quickly, of course, you're in Singapore, and there's sort of 4 main crypto hubs we can think of within Asia: Singapore, Hong Kong, Tokyo, and Seoul as well. Where do you think you're seeing the most progress right now on the stablecoin front?
Well, right now, in terms of regulation, Japan is far ahead. They're far ahead of any country in the world, in fact. Almost 2 years ago, they put in place, over a year ago, I should say, they put in place their stablecoin laws. It's very thoughtful. It creates a way for foreign issued stablecoins like USDC to be able to function there. And we've made some announcements about our intentions and what we're planning to do with bringing USDC to Japan under the regulatory regime they've established. So just narrowly for our business, like Japan is sort of has moved ahead. But both Hong Kong and Singapore are very actively working on this. There's frameworks that have been out for consultation that are going to legislative drafting, and so I don't know if it's a race but whatever, but like there's a real effort there, but more broadly, Singapore continues to make a lot of progress in licensing and attracting a lot of firms globally, and I know the industry broadly is excited to see what emerges with Hong Kong, who's now obviously been granting more licenses and trying to continue to support this agenda.
All right, Jeremy Allaire, thanks very much for your time this morning. That was the CEO at Circle there, Shery.
Right, Annabelle Jewelers there joining us from Singapore. As we have breaking news at the moment, Bloomberg now has learned that Ampere Computing is exploring a potential sale. According to people speaking to Bloomberg, the semiconductor startup backed by Oracle has been working with a financial advisor in recent months to help field takeover interest. Now, we're being told that Ampere is open to talks with a larger industry player about a possible transaction. Remember, the company back in 2022 said that it had filed confidentially for a U.S. IPO. The firm was valued at around $8 billion at that time, and this move could suggest that Ampere doesn't see necessarily an easy path to that initial public offering. So we're now being told that it's exploring a potential sale. Coming up, senior U.S. economic officials are due to meet with their Chinese counterparts in Beijing today. Details coming up next. This is Bloomberg.
Well, senior U.S. economic officials are due to meet with their Chinese counterparts in Beijing today as the Biden administration seeks to maintain channels of communication. For more, let's bring our China correspondent, Min Lo. So, Min, what do we know in terms of what's on the agenda? What is really kind of being hoped will be achieved here?
Yeah, so this is a trip led by a delegation of U.S. officials from the Treasury Department and the Federal Reserve Board, and it is a two-day meeting of the Economic Working Group. Now, that's a group that was created as part of two official working groups that were created after Treasury Secretary Janet Yellen met with her Chinese counterpart, Vice Premier He Lifeng. It's meant to maintain channels of communication, as you said, even as the Biden administration seeks to protect U.S. national security. So according to U.S. officials, the agenda here is to discuss China's economic trajectory, its industrial overcapacity, and the macroeconomic imbalances there that has created problems for U.S. firms and U.S. workers. And again, this is a lower level meeting. Treasury Secretary Janet Yellen is not going. It's really following up on some of the pledges that they've had in the past. Remember, Biden administration has announced this tariffs on Chinese goods, and Treasury Secretary Janet Yellen was really at the forefront of trying to rally other allies to follow suit with taking actions in regards to these unfair advantage that they say Chinese companies enjoy.
A lot of trade conversations going on right now, especially given the challenges that China faces. The Commerce Minister already in Europe talking about EV tariffs.
Yes, so this is a last-ditch effort to try to avoid any sort of escalatory trade conflict as a result of the EV tariffs, because the deadline is looming next week. September 25th is when the EU members are voting for the final tariffs that will kick in November. And so the Chinese Commerce Minister Wang Wentao is on this whirlwind tour around Europe. He's visited Italy, he's visited Germany, and he's now in Brussels about to meet with the European Commission's Trade Commissioner later today. He had some warnings for Germany when he met with German officials on Tuesday. He said that these tariffs will seriously interfere with cooperation and trade investment between China and Germany. It would harm both countries. This comes, by the way, about just 3 months after German's Vice Chancellor Robert Habeck visited China, and also Spanish Prime Minister Sanchez visited China as well, surprising many people by breaking ranks with the EU to come out to question whether the EU should even impose this tariff as also. Time is really ticking down. Next week is when we're watching whether China would be successful in convincing these EU partners to reverse those tariffs.
Bloomberg China correspondent Mei Minlo there. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how we're trading when it comes to Kiwi assets at the moment. We saw, of course, the data showing that the New Zealand economy actually shrank less than what the RBNZ had forecast. Still, the Kiwi economy teetering on the edge of the second recession it would see in less than 2 years, but still looking like we're seeing quite a bit of sluggish growth there. We'll be speaking exclusively with the Prime Minister tomorrow.
This is the Asia trade. We're counting down to Asia's major market opens after we saw Wall Street selling the news. Haidi, of course, we saw that outsized 50 basis point rate cut by the Federal Reserve. The key question is, despite the fact that Chair Powell said the economy is basically fine, was this reactive to a slowing economy that perhaps is slowing too fast, or is it being proactive to get ahead of the curve?
Yeah, really the messaging from the Fed, from the dot plots, from, even Fed Chair himself saying that this is not kind of the new normal, so this is not what markets should be expecting. There's a big gap in terms of what market expectations are, in terms of how aggressive they still expect the Fed to be going forward. It'll be very interesting when it comes to see how this plays out for Asia, right, and particularly where this yen rally goes next.
Yeah, I mean, the fact that we got that sense that he was really in no rush to keep easing at this pace. We actually saw the dollar paring back some of those earlier declines. And the Japanese yen was pretty supported. Right now, we're seeing some weakness against the U.S. dollar, but still sitting at around that 142 level. We're seeing some upside for Japanese stocks after 2 sessions of losses already for Japanese markets. And the 10-year yield still sitting at around those 1-month lows. And this, of course, as we head towards the BOJ rate decision. decision on Friday. No change is the expectation at this point. Take a look at how the Kospi is coming online because they're coming back from a long holiday. We heard from the Korean finance minister talking about household debt and the focus on household debt, because when it comes to the Bank of Korea, of course, it's not just about cutting rates and stimulating the economy. It's always been about those financial risks. The Kospi is gaining ground about 0.9%. And this, of course, after 2 weeks of losses already. The Korean won sitting at that 13.25 level against the U.S. dollar. Haidi.
Take a look at how we're trading in reaction here this morning in Australia. This is the picture when it comes to the staggered open for the ASX. We're seeing a little bit of upside, about 0.25% there, though falling when it comes to Australian bonds, really tracking what we saw in trading in treasuries as well. Traders really are waiting for key jobs data for Australia, for guidance on the RBA's interest rate path. Of course, this has really been seen as the RBA just pulling further behind. But we have also heard from Prime Minister Albanese saying, look, it is a very different economic scenario facing Australia at the moment in terms of still having inflationary pressures that are top of mind for the RBA before they eventually get to the easing part of our cycle at the moment. We're seeing the Aussie dollar holding pretty steady, 67, 66, expecting to see really the rate divergence play out when it comes to the Aussie and also to an extent for the Kiwi dollar there as well. And Shery, you take a look at how treasuries are trading at the moment. The bond markets really understood a very different message to what Fed Chair Powell was trying to deliver.
Yeah, we saw some heavy profit taking as well, right, when it comes to that Treasury rally that's been going on for 5 months. But it's really been trying to understand the messaging coming from Chair Powell. Here's some of what he had to say after they delivered that outsized rate cut. And this, of course, marking perhaps an end to that single-minded focus on quashing inflation alone. Take a listen.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
Joining us now in the Tokyo studios, Naomi Fink, Chief Global Strategist at Nikko Asset Management. Naomi, great to have you back in the studio. I know that going into the meeting, you were actually thinking it was going to be a 25 basis point cut. Who could blame you? I had no idea 25 or 50 was the big question. But does it worry you then that at this time they actually decided to pull that outsized rate cut? Does it give you concern about the U.S. economy at all?
Well, just to clarify, my view was that I thought that the 25 basis point cut would be most appropriate given what we've seen of the economy in the U.S. already. Even though unemployment has started to tick up, we haven't seen any worrying weakness in the labor market. And we have seen inflation come down, but even per the Fed's own projections, we're not likely to see it hit target for another couple of, well, at least a year. More than a year. So I didn't particularly see any economic indicators that would have called for the 50 basis point cut. However, what we did see is that it was priced into markets. So we could possibly say that the extension of the U.S. recovery owed in part to easy financial conditions, and the market made it very easy for the Fed to engage in the 50 basis point cut without giving rise to new worries about growth. I also understand that Chair Powell is saying that this is not going to be a sustainable pace because there isn't enough in the economy to justify a sustainable pace of continued 50 basis point cuts.
I mean, the market reaction has been pretty tame to what it could be, right? Especially if you see Asian markets right now, we're not seeing those crazy moves on the Japanese yen too that we saw the last time when we had, of course, these moves by central banks. But when it comes to the pace forward, as you said, do you think the messaging was appropriate from the Fed?
Well, I think the messaging is more in line with economic fundamentals than the move itself. And I think the Fed made very clear for this reason that it was a confidence-boosting measure, particularly since markets had already priced it in. The thing that worries me a little bit going forward is the potential for disappointment somewhere further along the line. Although markets had priced it in, the Fed was above neutral, all of the estimates of neutral are probably below where we are still. So they did have the ability to offer this bigger cut. The thing that might happen, though, if inflation doesn't continue to subside as the Fed projects, is that at some point markets may price in a bigger move than the Fed is able to deliver, and that potentially would disappoint markets.
That would seem to be, if the gap doesn't close between expectations and what the Fed is saying at the moment, that seems to be the scenario that we're facing right now. Going into this, we talked, Naomi, about just the, almost unprecedented level of uncertainty and debate over what we get. Do you think this level of volatility is kind of the new norm through this part of the cycle?
Well, there's one thing that I really would encourage that we consider right now, and that is that equity markets and bond markets are pricing in two different scenarios. Bond markets are looking for additional Fed cuts, which would imply that we should see economic weakness in the future to merit those cuts. Equity markets, on the other hand, are still pricing in double-digit earnings growth. So it appears to me that, well, we can't have both, and while we do have both, one thing is happening that's not very portfolio friendly, which is that U.S. Treasuries are not providing an adequate hedge against the equity market risk. So we're going to have to look at other assets to provide that hedge, and those assets are few and far between if we consider the size and the depth of the U.S. Treasury market. So it seems that either we're going to have the two meet in the middle, or one view is going to have to prevail. I do hope it's the one of at least moderate growth. However, the bond market is pricing in something different.
When you take a look at the trading opportunities around the region, right, obviously there's some divergence and some discrepancy plays here. What's compelling to you as we enter kind of the new expectations of potentially a more aggressive Fed cutting cycle?
Well, at least to begin with, it does appear as though a lot of Asian markets, Asian currencies, stock markets are gaining the immediate benefit of the rate cut expectations, if not the delivery, given that it was priced in prior to the rate cut itself. The carry trade, as we knew it when the Fed was on a hiking path and kept rates on hold higher than in many other countries, that's breaking down. So then that makes a lot of currencies that were not so attractive to hold more attractive than they were before. However, I think that it really does depend longer term what the U.S. economy does as well. Given China is a bit soft right now, more than a bit soft, then if the U.S. economy softens, that could be quite worrying for economies that do have large external surpluses, and we have a lot of those in Asia. So I am still quite positive on Asia. I think the region provides some decent diversification, but I would look at cases in which we can actually have diversification from domestic demand in a lot of the Asian economies. And I think Japan provides this type of case with consumption at least slowly picking up and real wages now in positive territory.
Do you think we're going to get more signals coming from the BOJ that they will continue tightening? I mean, we're not necessarily expecting big changes in this meeting, but what are you looking ahead to, and any signals from Governor Ueda?
I think the BOJ does remain on a tightening path, and we have received signals from Governor Ueda that the BOJ remains on a tightening path. I don't think that means they're going to have to move every meeting. In fact, I don't believe that they're likely to move every meeting or justified in doing so. However, I think every economic indicator that shows more robust domestic demand growth adds another point to argue for an upcoming rate hike. And the BOJ, thankfully, can afford to withdraw stimulus in a very slow and measured manner. But I think the trend is still towards a tighter policy.
Naomi, Fink, Chief Global Strategist at Nikko Asset Management. Good to have you back in the studio. This, of course, as we react to the Fed and also we look ahead to the Bank of Japan's policy meeting and decision on Friday. But take a look at how SK Hynix is trading at the moment, because we are seeing big falls, the worst day in more than 2 weeks. And this, of course, coming as Morgan Stanley just cut the recommendation on the stock to underweight from overweight. Their price target set at 120,000 won, implying a 26% decrease from its last price. Already we're at the lowest level since February of this year. Of course, we have seen SK Hynix really move in tandem with NVIDIA, its biggest customer, but at the same time, these skepticism and concerns about where the chip industry goes from here and the value and use of artificial intelligence has really been in focus. Still ahead, U.S.-China trade tensions back in focus as senior economic officials from both sides prepare to meet in Beijing. This is Bloomberg. Take a look at what we're watching when it comes to the reaction across Asian FX. We did see a bit of fluctuation when it comes to the US dollar after the Fed delivered on that jumbo-sized interest rate cut overnight. But of course, the messaging kind of massaging out some of those expectations. Big gap between where certainly bond traders at the moment are expecting more aggressive moves going forward to continue after that big move. But the Fed really trying to make it clear that this is not going to be the new normal. Currencies have been largely kind of in that range as we awaited for the Fed. Watching dollar China at the moment as the Bloomberg US dollar index has been pretty much unchanged at this point. We did see the yuan rising to that fresh 2024 high after the Fed decision. At the same time, senior U.S. economic officials are due to meet with their Chinese counterparts in Beijing today as the Biden administration seeks to maintain channels of communication. For more, let's bring our China correspondent, Min Lo. So, Min, what do we know in terms of the agenda and any sort of deliverables?
Yeah, we don't have a lot of expectations in terms of concrete deliverables out of this visit. It's a two-day meeting of the Economic Working Group. It's led by a delegation of officials from the Treasury Department and the Federal Reserve Board. And the intention here, according to U.S. officials, is to discuss China's economic trajectory, some of its macro imbalances, and the industrial overcapacity that they say have been very injurious to American firms and U.S. workers as well. And we know that the Biden administration has unveiled these additional tariffs on Chinese goods, and U.S. Treasury Secretary Janet Yellen was at the forefront of rallying allies to come on board with imposing some of those similar tariffs as well. So here we have the meeting between the two sides again to discuss some of these thorny issues. Janet Yellen is not attending the meeting. As I said, this is a working group meeting, really following up on some of the pledges to maintain channels of communication, even as the U.S. seeks to protect its national interests.
Lots of conversations around trade going on right now, especially given the challenges that Beijing faces. With the EV tariffs, we're now hearing that the Commerce Minister is also in Europe.
Yes, he's in Europe this week. It's a whirlwind tour of multiple countries. He's been to Italy, he's been to Germany, he's now in Brussels to meet with the European Commission's Trade Commissioner later today. And he's really there for a last-ditch effort to prevent any sort of escalatory trade conflict as a result of the EV tariffs. And September 25th, that's next week, that's the deadline for the EU members to vote on those tariffs. And Minister Wang Wentao had very strong warning for Germany in particular after he met with those German officials on Tuesday. He said that these tariffs will cause serious interference to trade and investment cooperation between the two countries. It will harm both Germany and China. And this came also after the Spanish Prime Minister recently visited China and surprised many people by breaking ranks with the EU, calling on the bloc to reconsider these tariffs. And you're really feeling that the tension is building up because Chinese state media has been been publishing editorials, some scathing ones that said that, quote, the EC's attitude of ignoring, resisting and rejecting China's efforts makes us wonder whether the European side is sincere in solving the problem. And this comes after Chinese companies had offered to put a price floor on their car shipments to Europe to address some of those concerns about Chinese cars being overly cheap. But the European Commission had rejected that offer, and the Chinese side is extremely frustrated, saying that the EU is just not willing to engage in any constructive discussion here.
Bloomberg China correspondent Min Lo there. And another story that we're following, China removing its zero tariff policy on 34 agricultural imports from Taiwan starting this month. The finance ministry says the move is in response to what it called the island's discriminatory restrictive measures imposed on Chinese exports. It adds to tensions between Beijing and Taipei that have mounted since May when Lai Ching-te took over as Taiwan's president. Chinese consumption edged up slightly during a major holiday this week from its pre-pandemic level, but the rebound didn't sway investors still fixated on the country's deepening economic woes. News desk editor Jill Deasy joins us now with the latest. Jill, there were lots of hopes that perhaps tourist spending during the Mid-Autumn Festival could support the economy a little bit. How did that go?
Yeah, we're not really seeing a ton of promising news in this data. Obviously, consumer spending has been under pressure all year. Really, at this point, for the last couple of years, we've seen a lot of issues with, risks of deflationary spiraling within China. But these types of, multi-day holidays are really a chance for us to see, whether or not the Chinese consumer is actually going out and spending. We just didn't really get that much out of this three-day holiday. If you look at sort of a broad-based effort in terms of, domestic tourism spending over this holiday, it is up 8% in the aggregate over 2019 levels. So that's from before the coronavirus pandemic. But then if you look at sort of its spending per tourist, this is a much more useful metric where we actually just kind of drill down and look at how much an individual is spending during these types of trips. That only eked up about 1.6% this year from that period 5 years ago. So really just showing you that there's not really a meaningful difference in terms of how much people are actually spending during these holidays. We will get another chance just in a couple of weeks during like the big Golden Week holiday in China for another chance to see whether or not people are actually spending a bit more money. But ultimately, yeah, it's a pretty downbeat story here, just showing us that the Chinese consumer is still really, really reluctant to spend. And this is, of course, adding to additional fears over the state and the health of the Chinese economy right now.
There's a couple of key sort of transmission, I should say, mechanisms for wealth in China, right? One would be the stock market, the other would be the property market. Given how volatile to the downside largely both of those have been, are we seeing that have a meaningful effect on household sentiment?
Yes, certainly. I mean, I think the property market and how poorly it's performed over the last several years has been really at the center of not just the waning story about consumer confidence, but also just the larger concerns about how China is performing more broadly, how its economy is performing more broadly. I mean, obviously, the government has taken several steps to try to improve sentiment, either within the stock market or within the property sector. Of course, the stock market being important given how many mom and pop traders there really are participating in this domestic stock market, but that still just really hasn't moved the needle to the extent that we've been able to alleviate some fears on, what we're worried about when it comes to the Chinese consumer. Again, I mean, the government has taken a lot of steps to try to ease policies, particularly on the monetary policy side, whether it be in the form of, cuts to reserve requirement ratios or, rates and stuff like that. But it just really hasn't moved the needle that meaningfully. What it does seem like is, there's been increasing calls among analysts for the government to do more on the fiscal side, maybe, some kind of, really, really big, big budget stimulus that may be able to help. Of course, the government has been incredibly reluctant to resort to those types of measures to help the economy. And I think, the bottom line here is that all of this is telling us that more likely than not, China is probably going to miss its growth target of about 5% for this year.
Our news desk editor Jill Deasy is there with more ahead on the Asia trade to come. This is Bloomberg.
Take a look at this one stock in the Japanese session that's falling almost 1%. Icom is a Japanese maker of wireless communications equipment. They're now saying that they're aware of this report that its devices could have been used in that attack in Lebanon targeting the Hezbollah group. Of course, in Lebanon, we have seen more than 20 people killed over the past 2 days. The attacks have widely been seen as an escalation by Israel, and this stock is now falling despite the fact that most Japanese sectors are gaining ground in today's session, Haidi.
Yeah, really, the mystery deepens in terms of the origins of these devices. We'll continue to watch for further information. But of course, as you alluded to, Shery, Iran now threatening to retaliate after its ambassador was wounded in this wave of explosions that targeted pages, other wireless devices in Lebanon. Walkie-talkies was the latest. Hezbollah, the Lebanese government and Iran all blaming Israel for the near simultaneous blasts. Meanwhile, Israeli Defense Minister Yoav Gallant ushered in what he calls a new phase in the war in the Middle East. Bloomberg's Michael Heath joins us now. So it does seem like, with these very brazen attacks, it is a new phase.
Yeah, I mean, it almost seems like Israel's sort of trying to goad Hezbollah into responding. But the sense from the government is that as the war in Gaza, I mean, you wouldn't say it's winding down, but it sort of seems to be stagnating, and Israel seems to sort of be indicating that Hamas, while it still exists, is militarily sort of fairly impotent at the moment, that they're swinging to the north. And I mean, the domestic background, again, is that it's long been said that Prime Minister Netanyahu needs the war to continue in order to avoid any recriminations over October 7th or a new election. It's probably a bit too cynical to say that this whole thing is based on political considerations, but because the whole Israel Hezbollah thing is sort of been waiting to happen since basically their ceasefire in 2006. But I mean, Hezbollah and Iran have threatened to retaliate, but Israel also assassinated officials in both in Lebanon and in Iran, and they didn't really respond there as well. So it's difficult to see what will happen. I mean, part of me thinks, and I guess the general sense is that we're on the cusp of an escalation. That if Hezbollah does hit back hard, Israel may use that as a cause for war. But Hezbollah is a very different beast to to Hamas. It's very, very well armed, well trained. It's waged war against Israel before it survived this 2006 war that they had, and it's Israel's forces have to be fairly tired. Its ground forces have been fighting for almost a year as well. There's only so many men who fight in that. So, yeah, I mean, look, it's a very, very tense time now, and it could be we're on the cusp of escalation.
So to basically risk a second front, I mean, is it because there is meaningful fear that there could be a similar incursion like on October 7th? Well,
whether it's a similar incursion, but I mean, Hezbollah just has so many missiles and really, really good, high standard missiles that can do a lot of damage in Israel. And the fear is that if they were to really let go of barrage, that Israel's much vaunted missile defence could be overwhelmed there. So, yeah, I mean, that's sort of the issue we're looking at here.
Bloomberg's Michael Heath. More ahead on the Asia trade. This is Bloomberg.
The Fed lowered its benchmark rate by an aggressive 0.5 percentage point to bolster the U.S. labor market, but JPMorgan Asset Management's chief investment officer says the decision was still slightly less dovish than he expected. Bob Michele also told us they're keeping a close eye on credit spreads following the rate decision.
It hit on pretty much everything we were looking for, probably a little less dovish than we thought in two instances. One, there was a dissent, so it wasn't a slam dunk, and we would have liked to have seen the median dot for the end of next year somewhere around 2.75% to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
Bob, which bond series or individual bond provides the most information right now? Is it a real yield? Is it the nominal full faith and credit? What's of the most value to Bob Michele right now?
Credit spreads. Credit spreads will tell us whether investors believe the economy is in dire shape and this was an emergency 50 basis point cut, or whether this is just a Fed a long way from neutral, perhaps, as Mohammed hinted, a meeting or two away from where they should have started the cycle, so they're starting to get towards neutral. All is well.
Okay, all is well. And yet what we saw earlier this morning was an increase in mortgage applications. What we've seen is already the bond market pricing in all of this and then some, and basically this statement only encourages that even more. Do you not see a risk of potentially reignited inflation, Bob, that we could potentially see expressed in the long end? As Mohammed was mentioning, we are seeing that yield curve steepening in a way that hints that something else is amiss, especially when paired with gold.
Whoa, whoa, whoa. We're a long way away from that. We're looking at the 3-month annualized rate of core PCE running at 1.7%. So that's not inflationary. There's signs of disinflation everywhere. When you look at the labor market, they talked about full employment. Well, the low in unemployment was 3.4%. A couple months ago, it was 4.3%. That's up 0.9%. You only see that when there's threat of recession. That's characteristic of that. They've highlighted to us that the neutral Fed funds rate is somewhere around 3%. That's a debate we could have for a long time, but it's nowhere near 5.25%, 5.5%. So they can start taking pressure off of businesses and households without reigniting inflation.
JPMorgan Asset Management Chief Investment Officer Bob Michele there, speaking with Bloomberg's Tom Keene and Lisa Abramovich. Take a look at how we're trading here in Asia, of course, as we continue to really have that reaction after the 50 basis point rate cut from the Fed, and the messaging, though, that really was the warning that this is not really the kind of the new norm for outsized moves to be expected. Of course, Treasury traders, bond traders, very much believing in a more aggressive path of action forward there. We are seeing some broad gains when it comes to most Asian markets. The Nikko 225 up by 2%. That sort of rebound rally continuing as we see that strength continuing in the yen rally there. Aussie stocks also up by just about 0.5%. Some caution there as we get into jobs day data expected a little bit later today. And of course, that move from the Fed just widening that gap between the RBA, which is largely seen to be somewhat behind the curve. Take a look at how we're trading when it comes to broader FX. Some to and fro for the Bloomberg dollar, and the Bloomberg dollar index is currently trading pretty flat at the moment. It did stage that recovery after the Fed voted for that half-point cut there. A lot of variables when it comes to that dollar scenario. Dollar yen there, 143 is what we're seeing, as well as the Aussie dollar actually holding on to most of those gains, 67.68. Let's take a look at all of the implications for FX trading with Alvin Tan, who's the head of Asia FX strategy at RBC Capital Markets. We're seeing quite a bit of fluctuations when it comes to trading in dollar yen at the moment. Surely the fundamentals point in one direction and one alone, but is there some confusion over market expectations, how treasuries are trading at the moment versus the messaging from the Fed?
Well, I think the Fed yesterday was actually very on point for the market. And at the end of the day, the market was really quite unruffled. The equities were down slightly, interest rates were up slightly. The DXY index was pretty much unchanged. So I think that the market, of course, always tries to be forward-looking, and so it's pricing in something along the lines of another 70 basis points of cuts by year-end, despite the dot plot indicating only another 50 basis points. But it's not. I don't see it as a massive divergence from the direction of where we're going, which is indeed that the Fed has started easing policy. And I think that is going to be generally positive for risk sentiment. The impact on Asian currencies, however, is going to be somewhat mixed, I think. I think it's worth emphasizing that the interest rate differential in the dollar's favor remains quite large. And even if the Fed were indeed to cut another 50 basis points by year end, it's still going to be quite large in the dollar's favor. And that's particularly the case against the Japanese yen.
So where to for the yen? Do we see sort of some stability in the levels that we've been hovering at around that sort of 140, low 140s at the moment?
Yeah, I would expect the dollar yen to continue fluctuating in the 140s range, basically between 140 and 150. because there is indeed much has been made about the fact that there is a policy divergence between the Fed on the one hand, which has started easing, and the BOJ, which continues to normalize policy. But on the other hand, despite this policy divergence, as I mentioned, the absolute level of the rate differential between the US and Japan remains very wide and will continue to be very wide well into next year. So the yen has to basically navigate these cross currents between a narrowing rate differential, but one that remains wide at an absolute basis. So I think it's largely going to be very range-bound trading for the yen, especially if indeed risk sentiment and volatility were to calm down further.
Alvin, we haven't even heard Governor Ueda come out. I mean, remember what happened after he spoke in April? Remember what happened after he spoke in July? What will you be listening out for to see a potential sharp move in the Japanese yen and more volatility?
Certainly, we have the BOJ ahead of us, as you mentioned, and although no one really expects the BOJ to hike policy this week, but indeed, any guidance that it and Governor Ueda offers will be very, very closely monitored. I expect that he will be very cautious given the volatility that we've seen in August and in fact even in September with the yen. So I think he will be very cautious. I believe that he is unlikely to offer any clear guidance on when the next rate hike by the BOJ will occur. But he will, of course, emphasize that the BOJ remains on a policy normalization path.
When we saw the yen carry trades unwind and we saw that immense volatility, we thought that perhaps the renminbi carry trade unwind could be another source of volatility. Where does the yuan go from here, given where the Fed is headed towards its easing trajectory, depending on the pace of those cuts?
Yeah, certainly with the Fed starting on this easing path, I think likely dollar renminbi exchange rate has peaked out. It basically peaked out around 730 or so. And I think going forward, the renminbi will be an underperformer precisely because China's economy is still struggling. And unlike Japan or the BOJ, the PBOC has been and will continue to ease policy going forward. So there is none of this contradiction between policy widening and differentials. The fact is the US dollar and China rate differentials remains in the dollar's favor too, very significantly so. So I think going forward, the renminbi will underperform most of the Asian currencies versus the US dollar. Now, what that means is on a trade-weighted basis, I expect the renminbi to actually depreciate, again, on a trade-weighted basis.
When you say underperform, is that especially also against the Korean won? For example, we heard from the finance minister that they would be closely watching household debt levels. I mean, they've been dealing with a whole different series of risks in the financial markets as well.
Yeah, certainly the revival of the housing market in Seoul in particular, I think will keep the Bank of Korea from being very cautious in terms of its policy easing going forward. So I do actually like the Korean won in terms of its performance for the rest of the year. I think it can outperform the Asian currency basket in general. And that's not just because the BOK will continue to be cautious, but also because the Korean won does tend to do well in a generally risk-positive environment. And I think that's going to be the case with the Fed now on an easing path, and the U.S. not in any danger of falling into an imminent recession.
Alvin, how much wider is the gap between the RBA and the Fed now after the overnight move? And, do the expectations when it comes to the jobs data today change the trajectory and the pressure on the RBA to start cutting?
We don't think so. I mean, our view is that the RBA is not going to be cut until well into next year, probably in the second quarter of next year. So that means that there is going to be this policy divergence between the RBA and the Fed. Now, the problem, however, for the Aussie dollar is that number one is the market continues to doubt this hawkish hold by the RBA, and secondly, of course, China's economic problems is weighing on the Aussie dollar, particularly with iron ore prices having fallen as much as they have in the past couple of months. So the Aussie dollar is not, it's not a clear-cut positive case for the Aussie dollar, despite this policy difference between the RBA and the Fed. Nonetheless, I think over time, as the market really wakes up to the fact that the RBA is not imminently going to be cutting rates, that it will help to support the Aussie dollar, and that will help lift the Aussie dollar exchange rate through the 68 level before year end.
Alvin Tan, head of Asia FX strategy at RBC Capital Markets, with his views on all of the different currency crosses that, of course, we continue to watch across Asia, including the Japanese yen right now weakening against the U.S. dollar, that 143 level. We are seeing that upside with the Nikkei of up to about 2% at the moment. Every sector is in the green. Materials, consumer discretionary stocks are leading those gains. And, of course, all of this ahead of the BOJ rate decision as well. Not really much expected, given that Governor Ueda and also other board members have signaled that there would be no action on Friday. But this is, of course, after we already saw action from the Fed with its rate cut, the first one in more than 4 years. Well, the Fed's rate cut tends to sort of strengthen the yen, weaken the U.S. dollar. That could potentially hurt Japanese equities. But there's this group of stocks that appears to be less impacted. Japan's startup gauge, the TSE Growth Market Index, has rallied more than 30% since that dramatic equity rout after the BOJ's unexpected rate hike in early August. That's double the gain in the broader topics and Nikkei 225. Our Asia equities reporter Winnie Su joins us now with more on this. And Winnie, today's market action a little bit different from what we could have perhaps expected, given how the yen is reacting. But let's get started with this startup gauge and why we're seeing this upside when it comes to smaller companies.
Right. So in the end, right now, Japanese stocks is really about the yen story. So we saw just these couple weeks that the yen, the weak yen beneficiaries, the exporters, really they showed the lack of performance. But on the other hand, the strong yen beneficiaries, including the retail companies and also the smaller companies, like you said, are outperforming. And something very interesting about Japanese startups compared to these big U.S. Tech startups is that their scale remains small. And that's a lot of times because they have a lot of investor pressure for them to get listed. So they have to get listed at a quite small scale. So they don't have that capacity to expand globally. But on the flip side, that can be good when the yen strengthens, because the demand comes from the domestic customers, whether it be like the e-commerce platform or the cloud platform. That's all for like Japanese customers. And also because the import cost is then now lower, that is good for their profits as well. So in general, small caps tend to rise when the yen is stronger. However, for foreign investors to really be interested in them, they have to probably improve on their disclosure when it comes to the English information, and they should also show how they can continuously grow and expand.
I guess to your point then, is that why Japanese equities are higher today, because the yen is weaker against the dollar?
Yes. So like it's quite interesting now we're saying that yen around 140 to 143 is considered weak, because we've been seeing...
Yeah, remember 160?
Exactly. So that sentiment has changed so much over just the past couple of weeks, right? And right now, Japanese equities, it's rising on the back of a weaker yen, and people are focusing on what the Bank of Japan is likely to do tomorrow, although we're expecting it not to hike rates, because just looking at what happened over in August, that market chaos, they really wanted to prevent that, right? So with that, the Bank of Japan staying hold on the interest rate and the rate differentials remain large, the yen is still likely to be under pressure. So the weaker yen is still likely to provide some near-term support for Japanese stocks. So you can see that can potentially benefit the automakers that have been really struggling for the past couple weeks. However, something really important is around the earnings, right? 143 compared to what the companies are guiding right now, which is around 145 against the dollar. So if earnings are really seeing an impact, and we are seeing companies unlikely to show that the upward revision, that might actually weigh on Japanese stocks. So we'll have to wait to see that.
We need still our Asia equities reporter here with a view of what's happening across Japanese equities and, of course, that reaction to the yen strength as well. You can also turn to your Bloomberg for more on the BOJ decision on Friday. Go to TLI Vigo to get commentary and analysis from Bloomberg's expert editors. We have more ahead on the Asia trade. This is Bloomberg.
I see investing in China as largely a very attractively priced place that now has a lot of questions regarding the issues that I've just referred to. In other words, the economic issues and the political issues regarding property rights and whether it's still glorious to be rich and how that'll work. Therefore, there's a small percentage of our portfolio which is in China and will stay in China, through this process.
That was Bridgewater Associates founder Ray Dalio speaking to us earlier about China's markets and this idea of whether it's still glorious to be rich. That was at the Milken Institute Asia Summit in Singapore. Well, President Xi Jinping's decision to reshape the world's second largest economy has upended the lives of millions of ambitious Chinese professionals. We're talking about high-paying industries, including finance, consumer technology, property, now out of favour. For more on today's Big Take story, let's bring Bloomberg Senior Editor for Asia Finance, David Scanlon. So, David, for so many years, the party's power was sort of really dependent on the social contract, right, of delivering prosperity and wealth to these workers. So they're now feeling very lost. What is sort of the goal here in this policy shift?
Yeah, it certainly has been a shift, Heidi, and kudos to our colleagues in Hong Kong and China for delivering such an excellent piece. Really what we're seeing is that the sort of the three pillars of the economy over the last 10, 20 years, think finance, think real estate, think consumer tech, Alibaba, Tencent. These are the people that really drove the economy. They worked very hard. They were rewarded, and they were sort of the creme de la creme of China. That has been really turned on its head in the last few years. As you mentioned, Xi Jinping is really overhauling the economy, and they're really getting hit on all sides. We're talking tens of millions of people who are worried about pay cuts. They're losing their jobs. They're losing a lot of the perks that they got used to. Business travel, forget it. It's just not happening anymore. We had some tremendous sort of comments, anecdotes from people who are really feeling the pinch right now. We had an insurance executive who said he feels like his work is meaningless. Another broker said that the finance sector feels like rats on the street because they're just so undervalued now. So it's just a dramatic turn from what it was for years, where this was the driving force of the economy. Now they're really being cast adrift. It's a very difficult time.
And we're talking here about the most educated, the best and brightest of Chinese society. I cannot imagine the long-term effect being good for the Chinese economy here.
Absolutely not, Shery. It has such a ripple effect. So much about spending is around confidence. And if you don't feel confident in your job and in your prospects, you're still not going to buy a house. And that's why we're seeing such a slow rebound in real estate. You're not going to spend, period. And we're seeing that in retail sales. It's been quite dreadful. We're seeing some of the weakest months since the pandemic over the last couple of weeks, last couple of months. So there's just not a lot of consumer confidence, and that's playing out in the economy. We've had a number of revisions from the big banks, UBS, et cetera, are saying China's probably not going to reach that 5% target this year, 4.5%. And this really continues a steady grind down that we've seen for almost 2 decades. The days of double-digit growth in China are just long gone.
Bloomberg senior editor for Asia Finance, David Scanlon there. And this is really a good read, so take a look at that full story on today's Big Take. You can go to the terminal or head to Bloomberg.com. We have more ahead on the Asia trade. This is Bloomberg. The latest from the corporate front, Bloomberg has learned that Volkswagen and its oldest Chinese partner, SAIC, are planning to close a plant in China. That's in response to slowing demand for combustion engine cars. Sources say the factory in Nanjing could be closed as soon as next year. The site makes Volkswagen's Passat and Skoda cars and has an annual capacity of as many as 360,000 vehicles. Boeing is requiring some workers to take unpaid leave to preserve cash as the plane maker digs in for contentious contract talks with its largest union. U.S. workers face a week of unpaid leave per month as the strike continues. Sea's online retail arm Shopee has struck a pact with Alphabet's YouTube in Indonesia. It's hoping the video platform will help it attract more shoppers and stay ahead of rivals TikTok and Lazada. YouTube intends to add other partners in Indonesia and plans to expand its shopping efforts to Thailand and Vietnam in the coming weeks.
Shery, take a look at how we're trading when it comes to here in Australia. Of course, broad upside for most Asian markets trading across the region in the day after Fed Day here. We are seeing that fresh record high, though, in particular when it comes to trading in Australia on those Fed cuts. Of course, is coming ahead of jobs data, so that's actually probably adding a little bit of caution to this market, but still yet another record high for Australian equities. And just a reminder, the 10th season of Peer-to-Peer Conversations with David Rubenstein premieres today. You can catch the first episode tonight, 7 p.m. if you're watching in Hong Kong, 9 p.m. in New York. That is it for the Asia.